Hello, reader. So this is a article about SDCL Energy Efficiency, so otherwise known as SEIT, otherwise known as SEIT. Take your pick because there's more names than hot dinners, pretty much. So what I'm going to do, just just grab this as well, is just kind of cover my article today, so just drag this across as well. So this is their website, and this this is their current share price of 48p, 48p, and as you can see, it's a FTSE 250 company, so trading volumes are around sort of 5 million a day. So this isn't a forgotten stock. This is quite a it's FTSE 250 mainstream stock. Its valuation is not insignificant. So if we just open up, let's have a look. Let's see if we can get this open. So this is kind of their this was their balance sheet as at last reporting period. So portfolio one pretty much 1.5 billion pounds, a little bit of cash, or a little bit of overdrawn cash there, so intercompany balance, some debt at the project level. So what I'm doing with this balance sheet is, rather than just showing the top co, I've kind of brought out what I believe is the hold co and the project level debt and the project level assets. So this is kind of let's call it an unofficial balance sheet, but hopefully one that gives you somebody that's interested in looking at this better information about how it's made up and what makes it tick. In other words, this debt here isn't at the top co. Top co own have that debt, so it's debt at project level, but it's still debt. So I mean, at the end of the day, it's not a bad shout to just be looking at it in this way. So these values here translate through to these values here per share. So £1.34.6 in terms of the portfolio, of which 33 pence of that is is sort of debt, supported by debt. So about £1 is not debt. It's owned by SDCL, and and then obviously SDCL itself owns some debt, so it sort of nets off at about 90p. Now I've done various calculations to work out different things that have happened. So dividends have been paid. We've had some obviously cash flows come from those companies in terms of remittances back. So there's capital repayments that are going on. So I'm sort of assuming that in the same way that 9.4 was paid back as capital repayments in the period to September 24, that the same's happened here. So this is dropped by 9.4 million. We know from today's trading update, I think it was today, yeah, pretty sure it was today, the trading update, that the debt's now at 235 million. So that's where that extra 60. And what I've done is I've said, well, on the basis that this 70 million increase to debt is then reflected into the value of the portfolio. So we've borrowed 70 and invested 70, so we now have 70 million more of assets, essentially. Okay, so that's kind of how all these numbers tick together. Now obviously there's no assumption of profit in any of that, no assumption of so it's pretty much just static numbers. But by kind of running these numbers, we kind of see that this gets to 92.5p from 90.6p, if I'm right. See, that's an unofficial number as well. That one's the known NAV, and that one's the estimated NAV. Okay. Anyway, that's a little bit around it. So my article was um, just talking about, the company itself. And by the way, this whole video is not investment advice. It's just me talking about something I'm interested in. And if you want to watch it, that's on you. You make your own investment decisions. Um, and this article was published at theoakbloke.substack.com. By all means, if you enjoy these videos, then there's a like and subscribe, and feel free to do that to support these videos. And there's also a link on my website if could also just quickly tell you about that. Help Emmaus, and Emmaus is a fundraiser I've been doing. 109 subscribers have supported Emmaus because they enjoy these videos, enjoy and find, well, as you can see here, a lot of people find it useful. So I mean, it's not me blowing my own trumpet. That's just um, if you feel that it's useful for you as well, then why not give something back? The work that these guys do for Emmaus is, it's more than sorting out a roof over a homeless person's head. It's enabling them to get back up on their feet. It's a hand up, not a handout. So do help if you can. If you've already helped, then thank you very much. You're one of the 109. Good on you. Thank you very much. Anyway, that's just a little intermission. So back to our article, which is this. So, so the holdings that they have are just spread out over all sorts of. In fact, if you go to their website portfolio, choose a project. I mean, it's basically stuff all over the world. You've got some stuff in Vietnam, some stuff in Singapore, and this will be stuff like efficient air conditioning, chillers and bespoke air efficiency air compressors. So these are sort of running on an energy efficient basis, and then the business model is essentially um, the capex is paid for by SDCL, and then they'll charge a rent or a fee or some sort of recurring revenue. In the case here, it's 5 leading industrial counterparties, subsidiaries of large multinationals, and it's just sort of different ways in which it sort of earns an income from investing into energy efficiency. And kind of one of the interesting things with this is that let's go back to this. There we go. Much of it is in North America, and uh, the today's update was so 65, and these are just approximates. I think it might be sort of give or take a percent, but 2/3 of it in the US, about a third in Europe, and then just like a little bit in Asia, in Vietnam, Singapore. So today we heard that it's delivered substantial income in line with previous years. This stable performance covers the dividend. This gives you a little map of so in not in the current period to March, end of March, but in the period to September, so the sort of prior period, that's how much cash flow was generated. Out of that 66, 18.8 was interest payments, so gets deducted off. They also did some capital repayments. So you saw me take out some capital repayments in that chart a moment ago. That's basically what we're talking about there, which left 48 million remitted back to the parent, back to SEIT, that then paid for keeping the lights on at SEIT, finance costs, and that'll be the RCF, and then management fee, other expenses that take out the 12.8 of that, and then you end up with 35. Dividends to investors is then 34, so that minus that is 1.1 times covered, essentially. So you can kind of see how obviously those interest payments, the cost of debt is obviously going up slightly, did go up slightly in this period, but on the other hand, the amount of debt is reducing. And also that as projects come online, that this cash flow, this income is increasing as well. So the news that we know today is that it was in line and on budget, and on budget. I think in this chart here, you can kind of see last year 92 million. This year it grew in the first half to 48, which is that 48 you see there. So the fact that it was generally in line and delivered the expected distribution suggests that this will look something like another 48. So and what I'm saying there is that that would bring it, another 48 there would bring it to 96 versus 92 last year. So but I also noticed it's generally in line, not wholly in line, so it's one of the things I wanted to try and do was work out, well, where was it not in line? That would be interesting to know, but we don't know, because these are the sort of largest, the smallest holdings. These 22 are then sort of, these dribs and drabs. So there's quite a lot of things, like, I don't know, down here for example, there'll be there's battery energy storage, but somewhere just up the road there's then LED lighting. So there are a lot of different assets where you just never hear anything about them, but they're just trundling away, delivering some income, and they're rolling these out to, well, 1,000 different customers. So schools, hotels, blah, 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 all these different places across 42 states, and so on. So it's there's a little bit of everything, I guess you could say. But the big ones, so Onyx is the biggest, and then Red Rochester, Primary Energy, Driver, or Vartan as it used to be called. And you'll notice that some of these are sort of the same, but split out over, so 3, 4, and 9. Primary is actually sort of 16% when you add all of those together, and Onyx is 27 when you add those together. So the biggest assets are vast majority, about 2/3 of the portfolio. So let's kind of spend a little bit of time looking at those. We've looked at this chart here. We know that the NAV last time was 90.6p. As I say, I think it's increased to 92.5, minus any extra discounts, although they do say that they are not increasing discounts. So hopefully that 92.5 will actually feed through. But as I say, that is just an estimate. So if we start with the top one, which I've obviously said 24% of the portfolio, but it's 24 plus 3. So anyway, but you can see that alone is equal to that's 2/3 of the market cap of the whole business. So this is a big asset. Although, just kind of one other thing, just to be finicky about it, but that 350 is part of that 1460. So part of that £1.34, which of course 45 pence of that is kind of debt and other things. So when I say it's 67% of the market cap, I mean, net of debt, it's not. I'm saying it's 24% of the portfolio, not 24% of the NAV. Just be careful. These are sort of where people can catch you out, or you can misunderstand. So it's 350. It's about a quarter of that. 24% of that number, not 20% of that number. Just to be clear. Anyway. The nice thing about this was that they said it hit or exceeded its targets. The last year target was 110%. So and it delivered 13.6 EBITDA in last year's. So they also tell us that the operational went from 14. So these are solar panels for businesses, and essentially the businesses, they install them for commercial industrial buildings, and then earn, once they're live, they'll get kind of, it's like one of those business models where they'll install the solar panels for free, but then they get the profits from you using the electricity, and that there's sort of a return on investment once they're live. So the fact that the amount of live has tripled, and last year they earned 13.6, I mean, that could be, so it's about a million per megawatt that they're earning. So I've sort of said 51.5 on 53, so something like that perhaps. But that, like, so what I'm saying is that we're not necessarily just saying that it's 48 million times two. It could be higher, because certainly Onyx is going to be higher, because that's what they tell us here, is that it's on target. It's the capacity is tripled, or more than tripled actually, so that times 4 times 3.5 is 53 approximately. Also, that the good news doesn't end there. A sale could be imminent. And again, that 350 million proceeds does include 51 million of debt. Okay, so you take off the debt, unless the buyer takes the debt with them. They pay however much, and then they say, oh yes, we'll also sort of absorb the debt as part of the deal. We'll see, but the extreme top outcome might be, or could be, that they pay something like 350. If they did, excluding debt, then obviously that sort of wipes out pretty much. I mean, you can see it there, that wipes out the RCF debt and leaves about 110 million left over. I mean, realistically, the project debt probably has to come out of that as well. So that leaves maybe 80 million, and perhaps they won't get the full 350. They'll get close to, or they'll get some proportion of that. So, I mean, it might be that it wipes out the RCF, gives a bit extra. It might be it doesn't wipe out the RCF, but it cuts down the RCF. Could be a few different outcomes there, but the fact is that there's and also the other thing that might happen is they might sell all of Onyx or some of Onyx. They might just sell some of the projects, for example. I don't know. So that's the primary focus. There's bidders, there's a second round, there's due diligence. The manager expects this to conclude before the annual results. Now, the annual results are not far away at all. In fact, I wonder whether it would be realistic to get, let's see if we can get when that could or will happen. No, this news flow thing here is not much good, unfortunately. Okay, let's see if we can find it this way. So if we go to the investors bit, gosh, I must have agreed this thing so many times. Anyway, so, oh yes, hello. There we go. Right. So the last year's report was in June. So less than 3 months is kind of what we're saying, potentially. So within 3 months, we're going to know, hopefully know the outcome of Onyx, and how much they've sold it for, what they've made, how much they've. But you imagine if they wipe out that RCF debt, a couple of things happen. I mean, that finance cost of about 15 million a year disappears. So that, if that became a dividend, I'm not saying it will, but that would increase the dividend by about 40%. So what is currently a 13.1% dividend, if you add 40% to that, you get to a pretty tasty dividend. So I think the dividend at the moment is that, and then it would be 18.4 if they just said, right, fine, shareholders, we're going to give you the benefit of not having an RCF anymore. That will give you this extra cash. I mean, chances are it will be used for further investments or different things, or in buybacks. I mean, that's the other thing that they could do, because again, as you can see, I mean, I've got the buybacks. So the official NAV based on 90p, 90.6p, is that is that is a 47% discount, 47.1% discount. But if you strip out the so this bit here where I'm saying about noise refers to the fact that here you've got all these losses due to increases to the discount rate that have depressed the NAV. So in other words, if the discount rate reverted back to what it was before, bearing in mind that all we're talking about here is a theoretical discount based on interest rates and the cost of the risk-free cost of capital, which at the end of the day is, I mean, if you've got assets that are delivering pounds and pence, then it's up to you whether you want to decrease the value of your assets by that theoretical. But if you don't, then really you can look at it where you're buying them back at that figure there, which is 60%. I think it's 60.4%, which is pretty astonishing because if let's say 15 million of shares were bought back at 60% discount, I mean that's kind of like you're getting what, two and a half times the NAV back for the residual. Because if you're buying something at 60% discount, then you're buying 2.5 times more shares than the value of the NAV that you're losing, essentially. So it's a very, very interesting time, really, for this to be for sale and for this to be worth that much, if it can sell for that much, is pretty good. And obviously a very canny. They said they were going to invest into it. They obviously caned their RCF to the max. I think the RCF's limit was 240 million, and they've taken it to 235. So they've pretty much maxed it out. Let's max out the credit card because we're gonna get a return on it on doing so. Even though it'll cost us some money, it'll make us some money. And they're, hopefully this is going to be the proof of that. And that in itself, I think, is a reflective of the quality of this share if they can do that. They haven't done it yet. And the track record, by the way, is they bought UUU Solar, and again, the share was at a big discount, probably not as much of a discount as it is today, but it was at a large discount, and they sold it for well, it was sold for above NAV, slightly above NAV. But then one of my readers very rightly pointed out, they said, well, hang on a minute, you go back, I think it might have been 6 months back or 12 months back, that they bought it at one price. They then reduced the value of the NAV, so they took a loss, and then they sold it at a profit. So yes, it was at a profit, but it was actually just reversing a loss, really, and it was sold at a slight loss actually to what they bought it in the first place. However, so you can sort of look at it you could look at it as a positive and a negative, really. Red Rochester, so they have, they say that it was above projections but below budget. So they don't expand on say what they mean by that. They were above mid-year projections, although below full-year budget. And so you're left thinking, well, what does that mean? So here I explain it. So the performance in the first half was 8.3 million EBITDA, and that was 13% below budget. So 13% below budget would mean that budget would have been 9.6. So times that by 2, and then your budget is 19.2, assuming it's equal in both halves, which again I think is not an unreasonable assumption. So what they're telling us is that the second half EBITDA is above that. Okay, it's above mid-year, but below full year. So it's between that and that, but in any case, it's above that figure there. So that's, again, it's a positive outcome. They've also got some work going on with one of their tenants. So this is a business park with large tenants, including Kodak, including Glencore. So yeah, there's work going on to deliver significant performance improvements, and this will become, Red Rochester will become, I think, the biggest asset if Onyx sells. That and Primary Energy will be the sort of biggest assets remaining in the portfolio. So the fact that this, here offering the potential of significant performance improvements focused on advanced tariff amendments with Kodak, that's going to conclude very soon in the next 3 months. Continue to work with Li-Cycle that's being bought by Glencore, or sorry, is interested in buying Li-Cycle, and Li-Cycle are building a new hub processing center. So this is something to do with strategic metals and metals processing. So large energy customer. Primary is blast furnaces, and of course there's tariffs. Well, in fact, I should probably finish this video and go and watch the news about what Liberation Day actually looks like, because I think the news is just out. So anyway, I'll just finish this video for your benefit. But the primary energy delivered its budgeted EBITDA. It's on budget, so probably has the potential to be a winner among other companies that will be losers. It recycles waste heat, so it sort of works with blast furnaces and delivers district heating and different things. And then other companies within the portfolio, the smaller ones, on budget, in line with. So we don't know what underperformed because they only tell us that everything performed. But that this is sort of typical, really, that there's a lot of assets and they don't kind of list out everything and tell you everything. They'll tell you the highlights, the top 5, top 6. So that's kind of what we get today with the trading update. It's interesting they talk about the EVN, which is this one here. So EVN, they've increased it from 26 sites to 31 sites. They're talking about investing into it. They say it's one of the more capex intensive. It did elicit inbound inquiries from potential buyers, but because it offers significant further growth, that they will that SEIT will either do a project level financing for Zood, which is the company that own EVN, and this is electric vehicle network. So it's basically charging stations, for electric vehicles. And I kind of talk about it here that some of these recharging stations do charge a handsome rate for electricity. That if you buy it at home, your electricity will cost you maybe 20p. If you go and buy it from another at a place like EVN, it can cost you a lot more. It can cost you 70p or something of that nature. So obviously they're making some nice margin, and the business model, I think, is that they pay the capex up front, they install it for an operator to then operate it, so you don't have any operational costs. The operator pays those, but SEIT get a kickback on probably every kilowatt that's delivered to every vehicle that visits that operator. So it's just a way of just printing money, so to speak, on electric vehicles recharging, which of course they need to do. And then this bit here about noise. So again, this was sort of something that you could read and sort of think was a negative, but actually isn't a negative. I kind of had to read it about 5 times to understand it. But the environment continues to pose widespread geopolitical and macroeconomic uncertainties. This is expected to result in an increase in risk. So you kind of go, the NAV's going to go down, but no. The expectation is that the the discount rate, so the risk-free, or the discount rate that's going to be used will be the same as that used in March 2024. And again, you sort of look at that and think, well, hang on a minute, the risk has increased, so surely the cost, or the fair value has decreased. So it's hit the NAV negatively. But no, what this cryptic reference refers to is that back in March sorry, no, start again. Back in September, back at the interims, what they said was that they said, um, even though risk-free rates have decreased, we're going to not reflect that reduction. In other words, what they did was they said in September, uh, even though risks have decreased, we're going to keep it all at 9.4. So what they're saying to us is they're not going to increase. And that's why I think NAV will have gone up, because there's, from the looks of things, everything substantial is on target or above target. Obviously they've paid down some debt, so that's positive. They've obviously generated some cash, so that's positive. There's no reduction of assets because discount rates not changed, so that's positive. Obviously there could be FX adverse or positive FX movements, but again, I don't think there's much in the way of that, because the pound versus the dollar is not vastly different from 6 months ago. So yeah, all in all, just to bring this to a close, I think that the yield of 13.16% is pretty flipping good. The discount rate is really high for what this is. I mean, these are just, utility type holdings that, people need energy every day, businesses need energy every day. So unless we sort of say, well, all of a sudden, because of something, that US steel makers are not going to make steel anymore, or electric vehicles are not going to recharge themselves anymore. I mean, these are all just quite unlikely scenarios. So to apply a 9.4% discount rate is quite harsh, I think. But there we go. I mean, you can apply it if you like, and obviously the NAV is based upon that rate anyway. So yeah, I think this will re-rate in time. I think the the winners and losers that will come out of tariffs, that at the end of the day it's all about reshoring and making America great again. That's all good for energy producers or providers, which is what a lot of these are, or service providers that are providing energy and helping save the use of energy. This will be positive for the 2/3 that are in the US, and then the same in Europe. I mean, the the problem of using Russian gas hasn't gone away. Obviously the American LNG is an option, but that's obviously expensive. So energy saving in Europe's quite a high priority. And then the same in the Far East. I mean, things, populations in Vietnam, for example, populations increasing by about 1 million a year. Well, obviously they're going to need more energy. And the GDP growth is pretty strong there as well. I think it's something like 6%. So yeah, lots to be positive about. I mean, so you have to wait for the annual results in the next 3 months. But today's update, which was met with a 0.1% increase, is it just shows that I don't know, like it, there's obvious value, but people are just sort of overlooking it, or just saying it's too good to be true. I don't know. Perhaps if you want to put comments in why you think it's at a 47% discount official, and 60% if you agree with me that the 9.4 discount rates kind of a bit extravagant. And obviously the common thing to say is, oh well, it might not cover its dividend, it might have to cut it back. Well, there's no evidence of that. There hasn't been evidence of that in the past, really. And all I see is that it's, if anything, that dividend could rise. So 13.1% while you wait for it to rise. And hopefully we'll see some buybacks. They have said that that's something they want to prioritize. Anyway, I'm going to go and see what Liberation Day is all about for the Americans, this is the Oak Bloke signing off, and thank you for watching the video. As I say, if you want to like it, comment, subscribe, do feel free. If you want to subscribe to my Substack, that's easy to do as well. There'll be a little subscribe button on pretty much every article, so just if you'd like to. And thanks again for your time. Cheerio for now. Cheerio.